Welcome back to video number 2 on Chapter 3. Now we'll look at a specific example of prepaid expenses, in this case, prepaid rent. So here we've purchased 1 year of rent in advance for $6,000. So if I divide $6,000 by 12, I get $500 per month. And so now what we're going to do, they use the term expired. As the rent is used up, it expires or is used. So that's what they mean here by the rent expiring. So each month is going to get $500 here of rent expense. So initially, we debited prepaid expense, we debited prepaid rent on the balance sheet as an asset and credited cash to pay for it. Now, as we use it up, we're going to debit rent expense each month for $500, and then we're going to credit prepaid rent to reduce that $6,000 by $500. So once we do that, the balance in prepaid rent is going to be $5,500. So now let's do another prepaid expense, this time prepaid supplies. We've purchased some supplies on account. So we've debited supplies on the balance sheet for $2,300, and we've credited accounts payable to pay for that. Now, what we do is we go out and we inventory those supplies, and we find that there's $1,300 of supplies remaining. So if I subtract the $1,300 from $2,300, I get $1,000, and that must be then the supplies that we used, $1,000 worth. So now we will debit supplies expense for $1,000 and credit supplies, the asset, by $1,000. That's going to reduce the $2,300 by $1,000, and what will be left on the balance sheet will be $1,300 in the supplies account on the balance sheet. Okay, depreciable assets. We've had a little bit of an introduction to that, but here we've purchased some equipment for $24,000. And we've said that this piece of equipment is going to last for 60 months. So if I divide $24,000 by 60, I get $400 that we expect to be expensed in each month. So at the end of the month, we will debit depreciation expense and credit a new account for you, accumulated depreciation, on the balance sheet. So accumulated depreciation reduces the balance in the equipment account. So it's shown on the left side, but in brackets. We call that a contra asset account. And now the remaining amount of equipment to be allocated is going to be $23,600. That's $24,000 less the $400 of accumulated depreciation. All right. So now, which of the following is recorded with an adjusting entry associated with a prepaid expense. Okay, the answer is alpha is going to credit an asset. So if we prepay the rent, when we do the adjusting entry, we're going to credit that asset to reduce it. You'll notice that adjusting entries always include a income statement account and a balance sheet account, or contra asset account, as the case may be. All right. How do we report property, plant, and equipment? Of course, we're recording it at cost. So here we have our balance sheet. And that balance sheet has some assets on it, long-term assets, property and equipment, and they total $50,626. Now, we have some accumulated depreciation of $24,645. Actually, that's in millions. And our net property and equipment is $25,981,000. Okay, which of the following is equivalent to the book value of an asset? Now, the book value of an asset is a specific definition I really want you to know. We're going to need that as we go forward in the course. And what it is the cost of the asset less its accumulated depreciation. When I do that, I get my book value. That's the remaining amount of cost that we still have to use up. Sometimes we use the term carrying value also, as shown in the little footnote at the bottom of this slide. All right, deferred revenues. Deferred revenues or unearned revenues arise when we receive cash in advance from customers, but we haven't delivered any products or services. We haven't provided them, we haven't earned them. So we show that as a liability, as we said earlier. In the period those services are provided, though, the liability is being reduced and an adjusting entry is needed. So what do? We're going to take it out of unearned revenue or deferred revenue and put it into revenue on the income statement. Here's an example. We received $600 in advance from customers on December 23rd. By December 31st, we've provided $200 of those services. So we received some cash in advance, and when we did, we debited cash for $600 and we credited deferred or unearned revenue, a liability on the balance sheet. Now, when we provide those services, we're going to reduce that liability by debiting deferred revenue or unearned revenue by $200, because that's what the services we provided, and crediting service revenue on the income statement for $200. Okay, so how do we report those deferred revenues? Well, over on the right-hand side of the balance sheet, we have our current liabilities. And we have a lot of current liabilities, one of which is deferred revenue for $1,253,000. Now, accrued expenses occur when a company uses costs in the current period but hasn't paid for them. So what we do here, we're going to record the liability to be paid and recognize the cost as an expense. So how do we do that? Here, at the end of the year, $300 in salaries have been earned by our employees because they worked 3 days for which they have not been paid. So we need to reflect the fact that those salaries have been earned by our employees, an expense to the company. So what we do is we determine that it was $300 of salaries that we owed. So we're going to debit salaries expense on the income statement and credit salaries payable, a liability to pay for those expenses, on the balance sheet. Okay. If the company paid an employee $100 a day for a 5-day work week that runs from Monday to Friday, and December 31st is a Tuesday, what is the amount of the salaries adjustment, assuming Friday is payday? And if you answered delta here, they worked 2 days, and if they did that, we would accrue those expenses by debiting salaries expense for $200 and crediting salaries payable for $200. Now we'll take a look at utilities. Here, at the end of the year, we've incurred that. We've incurred that because we probably got a utility bill that we haven't paid yet. So now we owe $900. So, very simply, we say, okay, we will debit utilities expense for $900, but we haven't paid for it, so we're going to credit a liability called utilities payable. Now, accruing some interest. By December 31st, 1 month's interest has been charged for borrowing $10,000 at 12% interest. So how we would do that, we would multiply $10,000 essentially by 1%. And if we do that, we come up with $100. That's how much we have incurred in interest expense, but we have not yet paid for that. We'll pay that much later. So at December 31st, we will debit interest expense for $100 and credit interest payable, a liability, for $100. So a common mistake is that when we're recording interest payable on a borrowed amount, we sometimes mistakenly credit the liability associated with the principal. That would be notes payable in this case. But we have a separate account called interest payable, and to keep the balance owed for principal separate. So, if the company borrowed $20,000 at a rate of 6% annually, how much interest expense should be accrued at year end? So we've had all of November and all of December, 2 months. So the arithmetic's going to be 20,000 times 0.06, and that's for a full year. But we're only going to have 2 months worth, so it should be, if you answered bravo, $200, you would be correct. And the adjusting entry would be interest expense $200 and interest payable $200. And that seems like a good place for us to stop for this video. And when we return, we'll continue. Until then, bye for now.